There are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable.
Thanks for joining us on 9 News Plus. I'm Chris Bianchi. You may have heard about the failure of the Silicon Valley Bank last week, and you probably know there's been a lot of turmoil in the stock market after it, and even rumblings of another 2008-like financial crisis because of this as well. But if you're like me, you might not understand exactly what's going on and what might happen as a result of Silicon Valley Bank's collapse. So, Jack Strauss from the Daniel School of Business at the University of Denver joins us for more about this on 9 News Plus Now.
Jack, thanks so much for taking the time to join us and help us understand this a little bit better here today.
Sure. So Silicon Valley Bank last week experienced an unprecedented bank run where in one day, last Thursday, $42 billion were taken out in one day, leaving the bank forced to close because they were left with negative $1 billion. And when banks fall below zero capital, they're forced to shut down. Normally, the FDIC steps in and can turn around a bank within a weekend. However, there was two problems here. This is an unusually large bank. So this is the second largest bank failure. The largest bank failure was during the financial crisis of 2008, Washington Mutual, due to a whole bunch of bad loans to the housing market. This was due mostly due to a bank run. So what led to it? In one sense, Twitter. The day before, several very prominent venture capitalists in caps said there was problems at this bank. So just in one day, people literally ran to the bank, took the money out, and it fell. So, but I mean, it goes a little bit deeper. Over the last year, there's been a very large increase in interest rates, and banks are encouraged to hold treasury bonds. Those are safe. However, what you don't realize is that treasury bonds can lose value if you're forced to sell them early, and they lose value if interest rates rise. These bonds are worth less. So on Wednesday, Silicon Valley Bank announced they needed to sell bonds to get capital because of declining activity among Silicon in the whole, basically California. They're doing some layoffs, not major layoffs, but there are layoffs in the tech sector. So the bank was forced to sell bonds, but when they sold the bonds, they realized a loss. And what they didn't do properly, which is irresponsible, they didn't have a backup plan. They didn't say, okay, we're going to sell some bonds, and this is how we're going to shore up our finances. Instead, some people on Twitter, including some prominent tech people, said this bank's in trouble, and it wasn't really in trouble, but it became a self-fulfilling prophecy once there was panic, and so a bank never holds tens of billions of dollars in their vaults in cash. So inevitably, a bank run forces a bank collapse, and that's why we have deposit insurance, which is FDIC. Deposit insurance means that any depositor who has less than $250,000, and if you're married, you can have $500,000 in the bank, you're guaranteed. One of the problems with Silicon Valley Bank is that more than 85% of their depositors exceeded $250,000, and in many cases, more than $500,000. So in one sense, these people had a right to panic, because if the bank did experience a run, which it did, they potentially could lose money. President Biden and the head of Treasury since then has insisted no depositors, even if they had more than $250,000, will lose money in an effort to shore up the banking system and prevent other banks from potentially collapsing due to rumors and bank runs.
Okay, so a lot there, Jack. Appreciate that synopsis.
Sure.
I want to start things off to kind of clarify things, and please correct me if I'm wrong. So
Sure.
It sounds like what essentially happened here was there was a social media-driven run on the bank that was caused in part by the fact that the bank pulled a lot of money out of these U.S. bonds, which are typically, I think, seen as a fairly safe investment. But because of the rising interest rates, the bonds, the bank realized a loss as a result of that, and then that led to this very large bank's collapse. Is that correct?
That's correct. So what's unusual is that The banks do collapse. They've been relatively safe since the financial crisis. But what's unusual here is the speed of the collapse. One day, $42 billion. And that's why some people are referring to this as a Twitter-fueled bank run and collapse, because of the rapid speed in which the withdrawals occur. And the second reason why the withdrawals occur, as we mentioned, is that it had an unusually large amount of clients exceeding the cap of federally deposit insurance of the 250,000.
I guess one question I've got off the top of my head, especially with a lot of these 2008 comparisons, we'll get into more detail on that here in just a second, but specifically after the '08 financial crisis, financial regulations, I believe specifically was known as the Dodd-Frank bill, were generally supposed to kind of stop this sort of thing from happening again. Why did it not work here, or was it not relevant in this case?
Well, part of the Dodd-Frank bill in 2018 was pulled back under President Trump, and to help regional banks profit more. And in fact, the two banks that collapsed, Silicon Valley Bank and Signature Bank, were two of the primary pushers of weakened regional bank regulations. So big banks like Citibank, Chase Manhattan Bank, the big New York City banks and the big banks throughout the country are still very highly regulated. The regional banks, however, had less regulation starting in 2018. And that's why there is sharp losses on Wall Street on Friday and Monday among regional banks, because potentially they have not been stress tested as much as the large banks, which are required to be stress tested annually.
Interesting. So I guess to that, the stock market's had quite a few wild swings, and there are concerns this could trigger a big economic fallout, maybe an '08 level financial crisis. What do you think might be the case here in terms of what we've seen so far? What might happen?
Well, I think the contagion effect, which is the panic effect, which occurred in 2008, rightly because there was a large amount of large banks with very bad housing loans. Here, the fundamentals are much better. SVB, Silicon Valley Bank, had some poor fundamentals, but it wasn't enough to really drag it under the water. So it was more panic. The second bank, by the way, a second bank just went bankrupt last week, this week as well, which is a record. The second and third largest banks collapse occurred within a week, right? And that was because of cryptocurrency problems, and that was another regional bank. So Silicon Valley Bank had relatively local problems due to, the tech sector experienced during COVID a rapid rise in employment, right? A lot of the big firms doubled their employment, and now they're starting to lay off workers. And so some of the clients then of Silicon Valley Bank have been hurt. So their fundamentals have declined somewhat, but they could have survived this if it hadn't been a Twitter-fueled with caps panic.
Interesting. So social media obviously playing a big role here. To me, what's also kind of interesting is and by the way, you mentioned the tech component of all this. As we speak today on Tuesday, March the 14th, Meta announcing another 10,000 layoffs on top of the 11,000 they announced last November. That said, the Federal Reserve is set to meet coming up next week on March 22nd about whether or not to raise interest rates. Could what happened with Silicon Valley Bank affect that decision?
Yeah, yes, definitely. So the Federal Reserve, in one sense, can be partially blamed here. They've raised interest rates from last February to this February a record amount, from basically near zero to 4.5% to 4.75%, and they're projected to raise interest rates to either 5 or above 5 next week, and continue to raise interest rates over the next 6 months. However, the Federal Reserve now realizes that a continued rise in interest rates could threaten the stability of and the fundamentals of banks, because they hold large amount of these treasury bills, or bonds, which sometimes they're forced to sell if they need capital. And so I think the Federal Reserve, which values financial stability, of course, will slow down their interest rate rises. And that's one reason why what's been hurt over the last several days is the banking sector, yes, but overall, the Wall Street has remained relatively calm because they realize last less interest rate increases in the future.
Okay, so maybe the broader impact might be a little lessened based off of that with the interest rates.
That's right. So the good news, bad news is that yes, regional banks are likely to face continued scrutiny and some pressure because of they're going to take some losses if they need to sell bonds. At the same time, the Federal Reserve is unlikely to continue to raise interest rates at the same speed they have been.
Interesting. So perhaps some of those overarching lessons, and again, feel free to critique this how you will. It seems like the lack of regulations that were scaled back in 2018 may have played a role. Maybe SVB, Silicon Valley Bank, not being particularly diverse in their investments. Sounds like they were pretty dependent on these treasury bonds, right?
Yes, and obviously they're dependent on the tech sector, right? So they're very tech oriented, and the tech sector, as you mentioned, is suffering a pullback from COVID-led highs of stock valuations and employment. And what's interesting is that Silicon Valley banks, a lot of people use it, even in Boulder or in Denver's Boulder tech sector, use Silicon Valley Bank. And so the broader implication is that in the short run, a lot of these tech entrepreneurs, which relied on Silicon Valley Bank for easy funding, they were relatively easy lenders with low scrutiny for tech entrepreneurs, which is good, but at the same time risky. They're going to face a problem because they're not going to be able to find a bank that's so eager to lend to them.
Interesting. So maybe some of those down ripple consequences as a result of this, and that may include us here in the Denver Boulder area. I guess what's maybe kind of sum things up a little bit here. If you were telling the average middle class American what to do here or how to think about this, if anything, what would you say to the average Joe Schmo, maybe myself included?
The people who pulled out the money had over $250,000 individually, over $500,000 in a joint account. That's a lot of money. So more than 85% of those people who pulled out the money had that amount of money. So the one lesson is if you have more than that amount of money, you should put your money in different bank accounts. Put it in first. There's we have the Denver or Colorado has a whole bunch of both regional and national banks. You should diversify your banking accounts and not put more than $500,000 in one bank account jointly.
Okay, so diversify in terms of those bank accounts. That might be a good idea, especially for those of you who might have more than $250,000.
So that's why a lot of people don't have to worry, right? So that's why you're smiling, I'm smiling too. Is that I don't, in one sense, I don't feel sorry. I shouldn't say this, but I don't feel sorry for the people who ran the bank. They were foolish enough to put that amount of money in one bank. Now, sometimes they were businesses that were encouraged by Silicon Valley Bank to put their money in because they got business services out of it, like payroll. Silicon Valley Bank helped with their payroll accounts.
I believe Roku is one of those companies that had something like $500 million or something in Silicon Valley Bank, and that's going to obviously lead to some big consequences for them, assuming if they can't get most of their money back. But anyways, I guess any final thoughts on this on Silicon Valley Bank?
One of the fundamental thoughts is that Silicon Valley Bank is not too big to fail, right? The bigger banks aren't too big to fail. I mean, and so they were the ones that were bailed out during the financial crisis, but they're also the ones that are heavily scrutinized by the Federal Reserve and by the FDIC. So that's where your money is very safe because they will not fail. Whereas regional banks, as you mentioned, are often not well diversified. And Silicon Valley Bank did not even have a risk officer in place. And they engaged in very likely insider trading that the Justice Department today is now investigating. So it was a poorly run bank. So that's one reason why the contagion or panic has not spread to larger banks, because the larger banks typically are, not all the time, but usually better run.
I guess one final question, Jack, that came out of this. Do you think there will be more pressure to reinstate some of those regulations that were in place before they were rolled back in 2018 now?
Yeah, I mean, bank regulations I think, are good. Banks are insured, and Americans don't like their taxpayer dollars for bank bailouts. But we need to insure banks because it's very hard that's what caused the Great Depression, collapse of the banks. And the Great Depression rules, in 1933, then by FDR, established very strict banking rules, which ensured the banking system. So we need bank regulations that it only very minorly hurts bank profits. Banks should be willing, however, to have a little less profits to ensure the stability of all banks. And so what's different here, though, than 2008 is that the heads, the CFO and CEO, they were canned immediately. Whereas for many years, the people in charge at the big banks in Wall Street under the financial crisis, they kept their jobs. So one thing here is the regional banks will learn their lesson that if this happens, they're out of a job instantly.
Interesting. Okay, so maybe a little optimism there. So that's where I'm going to choose to close it because I like having that little dose, sprinkling of optimism at the end of all this. But Jack Strauss, Daniel School of Business at the University of Denver, thanks for enlightening us on the Silicon Valley Bank collapse and what it might mean for the economy now and for the future. Thanks so much.
Sure, my pleasure.